Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, May 23, 2017, looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And here we are right up against the 240.08 gap fill level we discussed over the last couple of sessions. And we basically filled the gap today and stayed up in this general area for the remainder of the trading day. And if you look at the 10-minute chart, you can see here that we just treaded water up in this range all day. And a lot of this, well, let me first say that if you look at the 60-minute chart, you can see here that we're consolidating in a bullish pattern to build energy for another move higher. Whether or not we make that other move higher tomorrow or have a failed bullish pattern remains to be seen, but this should be a pretty decent resistance point for the market. Let's go back to the daily chart for a second. Under normal conditions, when we see a daily chart gap fill level, you'll generally get a reaction from that level. So in this case, since the market's moving up into the gap, we would expect a reaction in the other direction, meaning downward. We haven't seen that yet, and in part, the reason for that is the light volume. And in light volume, and today's volume was about 47 million shares, below the average daily volume, and that's a 90-day average volume. And part of the reason is that we haven't seen the downward reaction is because the path of least resistance in light volume is at minimum of sideways, and traditionally it's in the upward direction. Now we may trade slightly higher, we may get up to the 241 level, that's possible, but the key is a close above this level. That's what would send the market higher, and it has to be a close more than a few pennies. If we closed at, for example, 241, that's a lot different than a close at 240.10. There's a big difference between those two things. A close above the gap by 2 pennies is not what I'm talking about as something that would produce a vacuum to the upside. But if we close at 241, 241 and a half, something in that neighborhood, that's a different scenario, and that has a higher probability of causing a vacuum to the upside for another 40 or so S&P handles. Or $4, for example, on the SPY. Now, barring some shock to the market, and I'll talk about that in a second, but barring some shock to the market, as we get deeper into this week, the likelihood of a sell-off becomes less and less of a probability as we get into the long holiday weekend. Under normal conditions, we will not see any kind of a meaningful sell-off into a holiday weekend, Monday being Memorial Day, so we have a 3-day holiday weekend. And generally speaking, of course there are exceptions to the rule, but generally speaking, it's unlikely that we see a sell-off going into a holiday weekend. Now, I think we have a speech at 8:45 a.m. tomorrow morning by Mario Draghi. What he's going to say, I have no idea. But what I do know is that he can say something to jolt the markets. That is possible. If he says something that does jolt the markets, then we can see some kind of a pullback in this market, and that would coincide with the market filling the gap today. So that wouldn't necessarily be out of the question, but anything of a larger magnitude would be unlikely, but yet again, and I'll talk out of both sides of my mouth, still possible. I'm not calling for a short position here. I'm just saying that it is possible. The market's still in an uptrend, and in an uptrend, the trend is your friend until the end. And right now, the trend is still up, so we have to take that into account, and it must be respected. So all in all, we had pretty much an expected day today. We filled the gap. We stalled out there. Now it's make it or break it for the market. Are we going to go sideways for a while? Are we going to continue higher? Or are we going to pull back? And we'll see what happens. I don't know that we'll get a clear picture the remainder of this week, but certainly as we get into next week, we should get a clearer picture of whether or not we're going to see another corrective phase in this market. And again, I don't think that will be the bear market starting. I think that there's still higher prices coming. The market should trade up into and through June, into July. I'm thinking that the top should come mid-July, and we'll refine that as time goes on. But right now, the trend is higher, and that's the way we're going to take it and play it. Moving over to the IWM. Now, today was a relatively positive day for the IWM. It wasn't up much more than the spider. It was up 0.3%, 0.36 percentage points, 0.36 tenths of a percent. The spider was up 0.25%. But yet again, we closed above the 50-period moving average. So that does lean on the side of positive as opposed to negative for certain. However, the IWM on the daily chart is still lagging the S&P. Now, I did see a headline today, and I'm not sure whether this is 100% true or not. I must confess I didn't read the article. I just kind of saw the headline in passing, and it was that there was a big outflow of money in the IWM. I'm not sure if it was within the last month or whether it was longer than that. But what I did see, it was north of $3 billion of outflows in the IWM. So I think that's meaningful to some extent. I'm just relying on the charts. I'm not so reliant on outflows and inflows into these and out of these ETFs. It's not really all that meaningful to me. That's really why I didn't read the article. I don't like to be influenced by that stuff. I just like to read the charts. And what the chart is telling me on the daily chart is that it's still nowhere near out of the woods on the IWM. In order for us to really get going on the upside, and if the spider is going to rally on the upside, as will the IWM, and in order for that to happen, we have to really get above 138.60 on a daily chart closing basis once again. Until and unless that happens, then the IWM is really going to struggle here, and I don't see the S&P going up 40 handles with the IWM staying below 138.60. It's just not going to happen that way. So until and unless the IWM gets above that level, I don't see the spider getting above 241, and therefore all we're really going to be doing is treading water for the most part until and unless one of these two things break, either in the upward or downward direction. We'll know it when we see it, but right now the IWM on the daily chart is telling us that it's struggling to catch a meaningful bid, and until it does, the broader markets really aren't going to rally to any meaningful extent. And that's the way I read the charts. Just keep it simple. Let's go over to the transports. And the transports are very similar to the IWM, as I keep repeating each and every night. However, the transports took one step in the forward direction today. And that step is a close at 9,009. Our important number was 9,005. If you remember, we talked about it last night and probably before that as well. So it is a positive close for the time being, or it takes this bearish wedge pattern off the table. That's what the probabilities would tell us. However, as we discussed last night, there's still a lot of overhead resistance right in this area. We have the moving averages right above us, and we have a pretty decent consolidation in this area here, and it's not going to be a cakewalk for the transports to just walk through that area. It just generally doesn't happen like that. If we gap higher, if we wake up one day to a large gap higher in the market, that will free the transports of this overhead resistance, and we could find what's called a gap and go scenario. Until something like that happens, there is overhead resistance, and that's going to put a cap on the market. So when you look at the transports and you look at the IWM, without a gap and go, it's going to be very, very difficult for those two indexes to really get through this overhead resistance. And until and unless that happens, then the spider and the S&P 500 is really capped at levels not too far away from where we are on the upside. Maybe 10 handles in the S&P, $1 in the spider, something like that. So what we're really doing is We're looking for leadership out of our favorite leading indicators, which are the transports and the IWM. And that's why we talk about them each and every day. And until and unless we get the leadership going in the positive or upward direction, very, very difficult for the broader markets to stage any kind of a meaningful rally and a breakout to new highs. A meaningful breakout to new highs. Let's take a look at the broker-dealer index tonight. Much of the same story as the IWM and the transports, and this is why I want to discuss it. Same overhead resistance scenario we just talked about, although here you have a bearish wedge pattern that has not broken above the red candle high. So this is still intact. So this is weakness. And then you have all up here, we were not able to get through this area. And as long as we can't get through that area, there's also a cap on the broker-dealer index. And you know what I always say, without the financials, the broader market has a very difficult time and is unlikely to stage a meaningful rally. So while the trend in the S&P is up and we're close to new highs, you look across the markets at some of these other instruments, some of the other indexes, and it gives a little bit of a different story. And I think this is really indicative of the larger or bigger picture from a long-term perspective that's really beginning to develop. It's called the topping process. And in the topping process, we can certainly spike to new highs in certain indexes, and we can make new highs, and certain things can rally and others can struggle. In the end, what we're going to find is you'll find that there were lagging indicators when the market turns down and we get into the bearish phase of the year, whether it begins in June or begins in July or maybe even August, whenever it begins, and we'll know it when we see it, and we'll certainly refine it as we get closer. But when we get into that phase in the August, September, October timeframe, when I am expecting a more meaningful correction in this market, we'll be able to point back to some of these non-confirming signals of bearish indications and say, see, the financials weren't confirming the move to the upside, or the transports weren't confirming the move to the upside. Whatever it turns out to be, we'll be able to point to some of the things that we've been discussing for quite some time as the indications of the market being in an unhealthy state rather than a totally healthy state. Okay, next up is the gold market, and gold took a hit down about $10 today, almost 1%, 0.8%. And while we're still in a bullish consolidation pattern, and this is essentially building energy for the next move higher, if it's going to make a move higher, as long as it stays inside of the low of this green candle, which happens to be 1236.30, then the gold market is still positioned to go higher. However, I think if we do come down even more, for example, tomorrow and or the following day or days, then the market will be supported at the 20-period moving average, $1,243, $1,244 in that neighborhood. If we continue to bounce around in this zone and the market does get supported at the 20-period moving average, then that is a bullish consolidation pattern, building energy for another move higher. So all in all with the gold market, not much has changed over the last couple of days. We're just bantering back and forth in this zone, and that's what I said last night, I believe, is it just needs more time to consolidate in order to build enough energy to move higher. So not a lot of change in gold. As we move to the silver market, silver did pretty much exactly what we said it was going to do, minus going up to the 50-period moving average, which is the red sloping trend line, the blue sloping trend line. But what it did was today it went for this red candle high that comes in at 1729. Today's high was about 1730, and we backed off. So this is somewhat of a reversal in the making. We'll see what the next few days brings. It could simply make a bullish consolidation pattern for another move higher. We need more time. Only time will tell with the silver market right now. There's no long play in silver. There's no short play in silver. You have to let the market have its time and tell us what the next larger move is going to be. Right now, we're in a neutral stance. Let's let the market give us more of an indication as the coming days develop. Moving over to crude oil. Crude moved higher today. When the chart, there we go. We're headed toward the 52, probably 52 and a quarter area, a pierce through of the 200 period moving average, which is the black sloping trend line here. Maybe on the outside, as high as $53 a barrel. At that point, the market will stall out and need to pull back, or at minimum of put in a consolidation pattern. But there still could be a little more gas in the tank for crude, no pun intended, for some upside up to the 52 and a quarter area, give or take. No surprises, this is what we've been talking about over the last few sessions in crude oil. Heading over to the U.S. bond market. Little bit of a pullback today, but all in all, we're still making a bullish consolidation pattern, moving sideways. It just needed more time. So this is nothing other than just a little downtick in a bullish consolidation pattern. This is generally going to move higher once this pattern is complete. It just needs probably another day or two. However, there's no long or short trade yet because of the length of this green up candle. It's not out of the realm of possibility for bonds to move down all the way back to retest the 20 period moving average, maybe even the 50 period moving average. Still closing above the low of this green candle would still maintain the bullish consolidation pattern, or it would become essentially a bullish wedge pattern at that stage of the game. Right now, it's more in a flag formation, and either way, it's telling us that bonds want to move higher. All we had was a little bit of a downtick today, but nothing that damages the bullish pattern that it's been making over the last several sessions. Net, no change in the bond market. However, when we do move over to the dollar, we see what looks to be a reversal taking place in the dollar. We never made it down to the bottom portion of the channel. We did pierce through my objective, which was 96.97, and today we saw a nice reversal to the upside. We need some follow through. It's too early to call a bottom, but I believe this is an area where a bottom was going to develop one way or the other, whether it was from slightly higher from last week or down here. Either way, I think there's a lot of room coming in the coming weeks and months to the upside. So it didn't really matter whether the bottom came last Thursday or the bottom came yesterday. Really doesn't make a difference in the big scheme of things, but this is a reversal in the making. I think higher prices are coming for the dollar, and once it does get going on the upside, we're going to be looking for the dollar to be north of 105. It's not going to happen overnight. These things take time. The dollar's not going to get back to the top end of the channel overnight. Again, it takes time. However, the dollar is beginning, at least in the beginning stages, of playing out as we mapped it out, just like the schematic says. So let's see if we get some follow through tomorrow. And with that, it's everything I wanted to discuss tonight. I'm going to leave it there. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.